Hey everyone, welcome back to the channel. Today we're diving into a book that has literally changed the game for investors worldwide. The Intelligent Investor by the legendary Benjamin Graham. This isn't just a book, it's the Bible of value investing. Warren Buffett himself called it the best book on investing ever written, and trust me, if it's good enough for him, it's worth every second of your time. In this video, we're breaking down the top 10 lessons from this timeless classic that will turn you into a savvy, unstoppable investor. We'll dive deep into real-world examples straight from the book that show you exactly how to apply these lessons. Whether you're looking to build your wealth, secure your financial future, or simply outsmart the market, this is the video for you. Remember to hit the subscribe button to receive our newest videos on financial advice. Lesson number 1, Mr. Market. The book starts with the legendary concept of Mr. Market. Imagine the stock market as a moody, unpredictable character named Mr. Market, who shows up every day to offer you a deal. Some say he's ecstatic and wants to sell you stocks at sky-high prices, and other days he's downright depressed, offering bargain basement prices. Graham gives us a perfect example in the book. Imagine you own a business and every day your partner, that's Mr. Market, offers to buy your shares or sell you his. Some days his offer is ridiculously high. Other days it's insultingly low. But here's the trick. Mr. Market's offers have nothing to do with the actual value of your business. They're driven entirely by his mood. So what should you do? Graham says to take advantage of Mr. Market's irrationality, if he offers you a fantastic price, consider selling. If he's offering a deal, consider buying. But most importantly, don't let his mood swings influence your view on your business value. This concept teaches us to stay grounded and make decisions based on the intrinsic value of our investments, not on the whims of the market. Lesson number 2. Your secret weapon, the margin of safety. Next up is one of the most powerful concepts in investing, your secret weapon, the margin of safety. Think of it like this. Would you walk a tightrope without a safety net? Of course not. Investing is no different. Graham teaches us to always buy stocks at a discount to their intrinsic value, creating a buffer, a margin of safety that protects you from unexpected drops or miscalculations. For example, Graham uses the example of a company with an intrinsic value of $100 per share. He suggests that you can only buy it if it's trading at $70 or less. Why? Because this $30 margin protects you if your calculations were off or if the market takes a downturn. A historical example from the book is the case of Northern Pipeline, a company with significant liquid assets on its books. Investors who bought shares at a discount to these assets, thanks to Graham's margin of safety principle, were well protected even when the stock market went through rough patches. The strategy isn't just about minimizing risk, it's about ensuring that you have a cushion that allows you to sleep easy at night, knowing your investments are protected. Lesson number 3. Investment and speculation. Know the difference. Here's a crucial lesson. Are you an investor or a speculator? There's a huge difference. Investing is all about digging deep, analyzing a company's earnings, growth potential, and financial health. You're in it for the long haul, making decisions based on facts and fundamentals. Graham highlights the example of the dot-com bubble in the 1990s. During that period, many speculators poured money into tech companies with no earnings and no realistic business models, driven by the hope that prices would keep going up. These speculators weren't investing, they were gambling. When the bubble burst, those who had been speculating were left with massive losses. On the flip side, an investor following Graham's principles would have avoided these speculative tech stocks and instead focused on companies with strong fundamentals and a proven track record. By doing so, they would have protected their capital and potentially even profited during the market's eventual correction. The takeaway here? Stick to investing, ground your decisions in solid analysis, not in the hope of quick gains. Lesson number 4. The Power of Diversification. Don't put all your eggs in one basket. Diversification is like building a financial fortress. Each asset you own is a brick that makes your portfolio stronger. Graham's advice? Spread your investments across various asset classes like stocks, bonds, and even real estate. This way, if one area takes a hit, the others can keep your portfolio standing tall. Graham uses the example of investing in both stocks and bonds. During the Great Depression, stock prices plummeted, but bonds, particularly those of financially stable companies, held up much better. Investors who had diversified into bonds were able to protect their portfolios from the full impact of the stock market crash. Moreover, within stocks, Graham advocates diversifying across different sectors. For instance, during the oil crisis in the 1970s, energy stocks suffered, but companies in other industries like consumer goods were less affected. By diversifying, investors could balance out the losses in one area with the gains in another. This approach isn't just about reducing risk. It's about ensuring that you're not overly dependent on any single investment or sector. Lesson number 5. Are you defensive or enterprising? Which type of investor are you? Graham splits investors into 2 categories, defensive and enterprising. The defensive investor is like a careful driver, sticking to the speed limit, avoiding risky maneuvers, and always playing it safe. If that's you, focus on a balanced mix of stocks and bonds, and go for well-established companies with a track record of stability. Graham gives the example of a defensive investor who might focus on blue-chip stocks like General Electric or Coca-Cola, companies with long histories of stable earnings and dividends. The investor isn't looking for massive gains, but rather for consistent, reliable returns over time. On the other hand, if you're more of a thrill seeker, an enterprising investor, you're the race car driver, constantly on the lookout for undervalued stocks that others have overlooked. You might look at small cap stocks or companies that are temporarily out of favor but have strong fundamentals. For example, Graham mentions that enterprising investors in the 1930s could have found great bargains in companies like North Pacific Railroad, which was trading below its liquidation value. Whether you're defensive or enterprising, the key is to know your style and stick to it. There's no right or wrong, just what works best for you. Lesson number 6. Ride the market's roller coaster. Ready for a wild ride? That's the stock market for you. Prices soar, prices plummet. It's a roller coaster of emotions. But here's Graham's advice. Don't let the market's ups and downs dictate your emotions. Stay cool, calm, and collected. Graham uses the example of the stock market during World War II. Despite the chaos and uncertainty, investors who keep their cool and continue to invest regularly ended up doing very well when the market recovered after the war. This is a perfect example of dollar cost averaging, a strategy where you invest a fixed amount regularly, regardless of market conditions. Over time, this approach reduces the impact of market volatility, ensuring that you buy more when prices are low and less when they're high. Instead of trying to time the market, Graham advises focusing on the long term. Investors who stayed the course during the turbulent 1930s, for example, saw significant gains by the 1950s. The lesson here? Don't get swept away by the market's roller coaster ride. Stay disciplined, keep investing, and let time work in your favor. Lesson number 7. The research game. Graham said it best. Knowledge is power. Before you put your hard-earned money into any stock, do your homework. Dive deep into the company's financials, its earnings, debt levels, growth prospects, and management quality. Don't just follow the crowd or chase after hot tips. Those can lead you astray. Graham provides the example of a thorough analysis he did on DuPont, a chemical company, by analyzing their finances. Graham identified that DuPont was significantly undervalued compared to its assets and earnings potential. Investors who followed this research-based approach could have bought DuPont shares at a discount and reaped significant gains, since the company's true value was recognized by the market. The goal is to find the stock's intrinsic value, which is its true worth based on all the facts. Once you know this, you can see if the market is offering you a bargain. For example, if you determine a stock's intrinsic value is $50 and it's currently trading at $30, that's a potential buy signal. But if it's trading at $70, you might want to pass. Remember, every dollar you invest should be backed by solid research, not hype or hope. Be a detective, not a dreamer. Lesson number 8. Patience and discipline. The investor's superpowers. What's your superpower? For Graham, it's all about patience and discipline. In a world where everyone wants to get rich quick, the intelligent investor knows that wealth is built slowly, steadily, and consistently. Graham gives the example of an investor during the 1929 market crash. Those who panicked and sold their stocks at a loss missed out on the recovery that followed in the 1930s. On the other hand, patient investors who held on to quality stocks saw their investments bounce back and grow even more in the long run. Graham teaches us to stay the course even when the market gets rough. Don't panic when your investments take a dip. Hold steady, stick to your strategy, and give your investments time to grow. For instance, an investor who bought Coca-Cola shares during the 1987 crash and held on to them for the next few decades would have seen tremendous growth both in share price and dividends. Remember, the market rewards those who are patient and disciplined. It's not about how fast you can make money. It's about how well you can grow it over time. Lesson number 8. Avoid the overconfidence trap. Confidence is great, but overconfidence? That's dangerous. Graham warns us that thinking we know more than the market is a recipe for disaster. The truth is, no one can predict the future with certainty, and even the best investors get it wrong sometimes. Graham shares the story of investors during the roaring 1920s who were overly confident that the market would keep rising. This overconfidence led to excessive speculation, high leverage, and ultimately the devastating crash of 1929. Those who believed they could outsmart the market with risky bets were left in financial ruin. Overconfidence leads to risky moves, overtrading, and poor decisions. Stay humble, stay cautious, and always remember that the market is unpredictable. Build in that margin of safety and never bet more than you can afford to lose. Another example from the book is the case of investor sentiment during the tech boom of the late 1990s, where overconfidence in the perpetual growth of tech stocks led many to huge losses when the bubble burst. In the world of investing, humility is strength. Lesson number 10, dividends, the unsung hero of investing. Let's not forget the unsung hero of your portfolio, dividends. Graham was a huge fan of dividends because they provide a steady stream of income. Even when the market is down, it's like getting paid to hold on to your stocks. For example, Graham points to companies like Procter & Gamble or Johnson & Johnson, which have consistently paid and increased dividends over the years. Even during tough times, these dividends can provide a cushion, offering returns while you wait for the stock price to recover. But the real magic happens when you reinvest these dividends. Over time, this can lead to explosive growth thanks to the power of compounding. Imagine buying shares and reinvesting those dividends year after year. Decades later, you could end up with a much larger investment than you initially started with, all while collecting regular income along the way. Look for companies with a strong history of paying and increasing dividends. They are often stable, well-managed, and less risky. In Graham's world, dividends are the backbone of a solid, reliable investment strategy. To wrap it up, remember that investing is an adventure, a journey filled with opportunities, challenges, and rewards. By applying these lessons from The Intelligent Investor, you'll be well on your way to mastering the market and achieving your financial goals. If you like this video, you're going to love the next one.